Imagine a person earning $700,000 a year, a surgeon at the top of their field, respected and comfortable. Now imagine that this person is one accident, one lawsuit, one illness, or one job loss away from discovering that they were not wealthy at all, only highly paid. This is the quiet, brutal distinction that the entire machinery of modern finance takes for granted, yet most people never fully grasp. The popular imagination conflates the affluent professional with the genuine billionaire, the successful lawyer with the family office dynasty, seeing only the outward signs of money. But to the institutions that actually control the flow of capital, these are two entirely different species of economic life, separated by a chasm of structural vulnerability. The salaried professional, no matter how impressive their annual number, is participating in a game of cash flow. The truly wealthy are playing a game of asset ownership, and the rules of these two games are not merely different, they are often opposite. To understand this fully, we must first establish a simple financial vocabulary. Income is the money that flows into your life, from your labor, your investments, or your business activities. Cash flow is what remains after you have paid your obligations, the oxygen that keeps your financial life breathing. Assets are things you own that can produce income or appreciate in value, like stocks, real estate, or a private business. Liabilities are claims against your future income, obligations that drain your resources. Equity is the true measure of ownership, the value of your assets after subtracting your liabilities. Wealth, in its final form, is a durable stock of owned assets that can survive without your daily labor. It is the fortress, while income is merely the supply line. A person earning a substantial salary can become wealthy, but only if they systematically convert that active cash flow into passive ownership. The distinction is not one of present comfort, but of long-term resilience. Consider the surgeon earning $700,000 a year. By any standard, this is a staggering income, placing them in the top fraction of a single percentile of earners. Yet this surgeon is vulnerable in a way that a true asset owner is not. Their entire economic life depends on a single source, the daily application of their skill. If they are sued for malpractice, their savings can be decimated. If they develop a chronic condition that prevents them from operating, their income stops. They may own a home and have a retirement portfolio, but these are often funded directly by the surplus of that continuous cash flow. They are a single, undiversified human capital asset, highly leveraged to the continued functioning of their body and reputation. They are wealthy in their lifestyle, but not yet in their ownership. The high salary is a brilliant flame, but it is still a flame that can be extinguished by a single gust of bad fortune. The path to wealth for this surgeon, or any high earner, is a deliberate conversion process. It is not automatic, and it is not simply a matter of earning more. The first step is to resist the gravitational pull of lifestyle inflation, the tendency to spend every increase in income on a corresponding increase in consumption. The second step is to build a reservoir of liquidity, a buffer of cash or near-cash assets that provides security and opportunity. The third and most critical step is to acquire productive assets. This means buying not just a larger house, which is often a liability that consumes cash flow, but buying claims on cash flows that come from elsewhere. It means investing in broad market index funds, purchasing rental properties that generate net income, acquiring equity in a private business, or building a portfolio of dividend-paying stocks. The surgeon who buys a portfolio of commercial real estate, or who builds a stake in a surgical center as an equity partner, is beginning to decouple their well-being from the singular operation of their own hands. This conversion process reveals a hidden but crucial distinction between types of assets. A primary residence may appear on a balance sheet as an asset, but it rarely produces cash flow. It consumes money through mortgage payments, property taxes, maintenance, and insurance. A rental property, by contrast, sends money back to its owner each month. Business equity distributes profits. A stock portfolio generates dividends. These are productive assets, engines that generate income independent of the owner's labor. The wealthy person's balance sheet is filled with these engines. The high earner's balance sheet is often filled with liabilities disguised as status symbols. This is the quiet architecture of financial power, owning things that pay you rather than owning things that cost you. The difference is not subtle, yet it is invisible to most people who judge success solely by the size of a paycheck. Consider the lawyer in a major firm who earns a partner's salary but holds no equity in the firm itself. They are a high-income earner, but they are still fundamentally a laborer, albeit a highly compensated one. Contrast this with a founder of a technology company who draws a modest salary but holds a significant equity stake. That founder is far more powerful because their wealth is not tied to the weekly performance of their labor. It is tied to the value of the company, a value that grows through the work of hundreds of employees, the strength of the product, and the judgment of the market. The founder owns a claim on the future earnings of an entire enterprise. The lawyer owns only a claim on their own time. This is the same distinction that separates a landlord with a portfolio of properties from a highly paid employee who rents their apartment. The landlord owns the machine that produces rent. The employee is merely a tenant in their own economic life. This dynamic is visible in the history of American corporate life. In the middle of the 20th century, a senior executive at a firm like General Motors could reasonably expect to work for 30 years, retire with a generous pension, and live out their days in comfort. That model was predicated on the stability of the corporate monolith and the loyalty of the employee. It was the final golden era of the income-based model for the elite professional class. But that world was dismantled by the financial revolution of the 1980s and 90s. The rise of shareholder value maximization meant that income became a cost to be minimized. The corporate raiders and later the private equity firms recognized that a company's most expensive line item was often the payroll, and they acted with surgical precision to cut it. The executive who saw themselves as a loyal member of the General Motors family was, in the eyes of the new financial titans, simply a line item on an income statement. The employee thought security came from income and institutional loyalty. The owners understood that control came from equity. Labor is an expense. Ownership is the claim on what remains after expenses. The tax code reinforces this hierarchy in ways that are both subtle and profound. Wages are taxed annually as ordinary income, often at the highest marginal rates. The surgeon who earns $700,000 shares nearly 40% of that income with the federal government in their highest bracket. The billionaire who owns a growing company pays a different kind of tax. The increase in the company's value is not income until they sell their shares. It is an unrealized capital gain, a phantom asset that grows untouched by the tax collector. They can borrow against this rising value, using it as collateral for loans that provide liquidity without triggering a taxable event. This is not a magic trick with no downside. Borrowing costs money, and if the asset value declines, the lender can demand more collateral. But it illustrates a key principle. Wages are taxed when earned, capital gains are taxed only when realized, and borrowing against appreciated assets can provide cash flow without an immediate sale. This structural asymmetry is not a conspiracy. It is a design feature that rewards those who have the capital to own assets and the discipline to hold them. The true power of wealth is revealed not in annual earnings, but in its capacity to endure and to replicate itself across generations. A high income can build a comfortable lifestyle, but it is almost always consumed by that lifestyle and the taxes that fund it. The wealthy family, on the other hand, builds a financial dynasty. They do not prioritize the annual tax bill, they prioritize the preservation of the principal. They employ family offices that function as their own private financial institutions, managing complex portfolios of stocks, bonds, real estate, and direct investments. These structures are engineered for permanence. designed to manage risk across generations. They face market risk, succession risk, and the possibility of bad investment decisions, but their primary goal is resilience. They are built to weather storms that would destroy a household dependent on a single paycheck. The salary is a single-threaded, high-risk life. The family office is a multi-threaded, risk-managed holding company for the ages. The elite knowledge, the insight that separates the merely affluent from the truly powerful, is that the goal is not to make the largest income, but to own the largest, most resilient, and most cash flow generating assets. Most people judge financial success from the income statement: salary, bonuses, commissions, monthly income. The wealthy judge it from the balance sheet: assets, liabilities, equity, liquidity, debt structure, and claims on future cash flows. The income statement tells you how much money is coming in. The balance sheet tells you how much you would have if it all stopped. That is the difference between a high standard of living and genuine wealth. The first is a temporary condition. The second is a permanent structure. The first requires constant maintenance. The second can be inherited, sold, borrowed against, and grown. The final, most unsettling insight is this: income buys lifestyle, but ownership buys time. The salaried professional is trapped in a cycle where they must continuously trade their time for money, a trade that becomes harder as they age and their health declines. The asset owner has broken this chain. Their assets do not tire, do not burn out, and do not demand a salary. They generate income while their owner sleeps, travels, or steps away from the daily fray. This is the ultimate power that wealth confers: the power to control one's own time, to live free from the immediate pressure of a single paycheck. The doctor who has built a portfolio of apartment buildings can choose to stop practicing medicine. The doctor who has only a high salary cannot. The distinction is not a matter of morality or virtue, but of financial architecture. The affluent professional has a high income. The wealthy person has a system. One is a high-wire act over a deep chasm. The other is a fortress on solid ground. The path from one to the other is not complicated, but it is difficult. It requires discipline, foresight, and a deep commitment to converting the fruits of one's labor into the engines of ownership, thereby ensuring that one's financial life is not a fragile dependence on a single source, but a resilient and enduring legacy.